Hello, Avila Advantage Finance students. We are now actually almost to the halfway point of the course. It's hard to believe, but this week, the nice thing is you don't have a forum discussion, so I'm going to allow you to focus on the problems you have due this week out of chapters 7, 8, and 9. And then your exam will be available this Thursday. So you'll have until the weekend to complete it. It's going to be a multiple choice exam. Make sure that you are at a place that you can be free from distraction and interruption. So once you start it, the timer goes, and just have it all submitted by the end of that time period that you're allowed. So this week, start to look at Chapter 7 with bond valuation and yield to maturity. I put a video out there and some examples out of your textbook. And then the idea is, with bonds is that it's an inverse relationship. As interest rates go up, present values go down. So if you have a bond that pays 6% annual interest rate, what we call the coupon rate, and all of a sudden interest rates go up to 8%, well, as an investor, I'm thinking that I can go out and get a better return, so why should I pay for your 6% bond that's only going to give me $60 a year when I get $80 a year? So the seller says, okay, I'll do this. I will lower the price of that bond so you get an 8% rate of return. So that's essentially what's happening in the market. So as new interest rates come out, there are also other factors too, that as the stock market maybe doesn't do as well, we've had a great run in the stock market, but say people get skittish and say it's overvalued, they may run to buy bonds for safety. And as the bond prices push up, that means your rate of return goes down. So that's really a lot more than what happens in the market. But the textbook traditional academic examples discuss more in terms of, what if current interest rates do change? And that is potential. The Federal Reserve in December may raise interest rates again. So if I'm having to offer a bond, I'm going to have to probably pay a higher rate of interest to attract you to buy that. And bonds, they vary by interest, again, due to their safety. Government bonds are going to pay something that's very lower rate. But if you are a corporation that doesn't have as good a rating for S&P and Moody's, you're probably going to have to pay a higher rate out in the market in order to attract those funds. So there's plenty of examples out there in Chapter 7, so read through them slowly, understand them. We look at Chapter 8. You're going to learn about what's called the Gordon growth model. Kind of the idea of first, before the Gordon growth, you're going to look at the valuation of preferred stock, the idea that I'm receiving this equal payment for almost infinity. And then you're going to look at what's called, I call the Gordon growth model, where they're going to have dividends of the dividend 1 year from now in the numerator divided by the required rate of return minus some growth rate. And it's just an estimate. It's a very basic model to say, hey, how much should I pay for GE today based on this dividend is going to continue to grow? Unfortunately for GE right now, I'm not sure their dividend is going to grow, and that's why the stock prices fell below $20 a share right now. The investors are kind of panicked and saying, hey, can't GE maintain these dividends anymore? It doesn't look like it. So they've actually discounted the stock price down to what they feel is an appropriate rate of return based on the dividend they're going to be able to give in the future. The last part with Chapter 9, you're going to start to kind of really put it all together. So when they talk about opportunity cost and economics, and how do you come up with this appropriate rate of return for the investor, which we're going to use with net present value later, they come up with what's called the weighted average cost of capital. So it kind of throws both components of how much of your company is supported by capital debt, how much is supported by equity. What are these weighted percentages? You could go out there and look at a particular company online on Yahoo Finance and see, hey, the stock of Great Plains Energy is worth, let's say, $100 billion, but the amount of debt that they have in the market is worth $50 billion. So I'd say, okay, I want to apply the weight of the equity as 2/3 of the capital and the debt as 1/3. And if the capital asset pricing model of the equity says the return is 10%, I'm going to take that 10% by the weight of 2/3 of how much equity is. And if the after-tax cost of debt on Great Plains Energy is, say, 8%, well, I'm going to say, hey, let's take the weight of that equity, or the debt, of 1/3 times the opportunity cost of that after-tax cost of debt. So it's saying, hey, this is a weighted average cost of capital. It's a return that we can use kind of as a benchmark to say we need to be making at least this return or better to our investors If we're not, later we'll see that I don't want to take this project on, or I have to be selective about which project I'm going to take on. So, okay, well, that's a brief overview this week. So, main things again, no forum discussion, but work on the homework problems, get those submitted, work on your exam, and just shoot me an email if you have questions. Take care and have a great week.